On you go.
Good evening all. Welcome to our inaugural webinar series. I'm Adrian Cormican from Hallcroft Finance, and joining me this evening is my esteemed colleague Martyn Pollock, who in truth will be doing the majority of the talking tonight, and I'm simply here to set the tone and field your questions. Thank you firstly for taking the time to put your details into our landing page and then putting us in your diary at 5 o'clock. As we planned out our new series of webinars, the most obvious question arose, which is why? Why are we doing this? And other than because Martyn told us that it was a good idea, we need to focus on why. Otherwise, it would be a wasted opportunity for you and us. We concluded 3 outcomes that we wanted to achieve. Number 1, over the years, our team has met thousands of potential clients and professionals. Well, we want to capture some of those on the periphery of our business and show them what we can do. We're really proud of what we've achieved, but alongside many other companies, maybe we don't communicate that enough. We're hoping this webinar and other things we have planned will change that. Number 2, education. There's a large part of our audience that are not developers or investors, but aspire to be, whether they be architects, surveyors, lawyers, bankers, or something completely unrelated. I'm hoping that you can derive value from what we have to say. 3, those that do know us, thank you for coming, including my mum. Hi, Mum. We want to use these webinars as a touch point for our continuing relationship. And don't worry, Mum, this won't be the way I'll continue to communicate with you. Last year was terrible. It was a terrible year for so many, for a variety of reasons that we do not need to list. Our business had been bumping along quite nicely pre-COVID, but in truth, it had no structured growth plans. That has changed beyond recognition. Our team has grown from 3 prior to lockdown to 6 now, and we're aggressively looking for the right people to help us execute a precise plan. The way we were all forced to work in a new way at the same time last year has the sense of a Hollywood movie at times, and the Truman Show springs to my mind. However, it's opened our eyes to new possibilities, and events such as this, which probably pre-COVID would have been hosted in a private members bar in London with restricted numbers, now we can reach a wider market. So let us move to the most important part of the evening. Martyn has lined up a talk for us this evening regarding a chicken shed, which is now 5 stunning new build homes. In fact, the client could not have timed this more perfectly with the world we live in. It appears he had a crystal ball. I'll let Martyn explain more on that very shortly. Just before I hand over, you'll see in your top right-hand corner of the screen 2 boxes, which will allow you to interact with either just the Hallcroft team via private chat, or you may opt to put something in the public chat where all those on the webinar will be able to see what makes you curious. Also, if you want to be notified about future events and are not on our mailing list, I'll add a box at the bottom of your screen where you can pop your details in throughout the webinar. Martyn, good luck, and over to you, sir.
Thank you, Adrian. Hello, and welcome to our inaugural deal clinic. I am Martyn Pollock, also from Hallcroft Finance, and I'll be taking you through today's talk. So let's start from the beginning. I guess the thought process behind the deal clinic was not to get too hung up on loan to cost, loan to GDV, rate, fees, or even the sort of finite detail. It's just for us to open up our knowledge on real estate finance and sort of highlight the problems and challenges that we're facing with our clients on a day-to-day basis, and also highlights the solutions that we found. We're also really excited to introduce you to our business. So we'll take some time to talk you through that and discuss the recent growth that Adrian's been talking about. But before I get started, let's get some admin out of the way. You may have noticed that I'm Scottish. You may even have thought that I'm Irish. So if you're struggling with this old rugged accent, feel free to use the wee Jimmy Kilt icon in the bottom left-hand of the corner of the webinar screen. Of course, I'm joking. There is no little wee Jimmy sign. So if you get any problems, feel free to get Adrian to translate if necessary. So without further ado, let's get started. So we've broken the webinar down into 4 parts. An introduction to our business. I'm sorry if we labour here, but we're so enthusiastic and passionate about our business. A short property finance market update, and then the meat on the bone will be the deal clinic and the completed transaction in rural aspects of Guildford. Finally, we will open up the webinar to questions and answers, and also we'll be dropping the odd poll question in throughout the webinar to keep it as interactive as possible and to make sure you're not falling asleep on us. So, for the first question, what is the minimum level of profit senior lenders expect to see in a development appraisal? What do you think? A, 10%, B, 15%, or C, 20%? Adrian, start that timer.
Timer's rolling, Martyn. I can see a few people answering straight away. We'll give it a few more seconds. People are listening, Martyn. I can confirm that. Right. Answers are in.
Okay, so the answer, well, so it used to be 20%, a target 20% profit on costs. But the market is moving, and currently, if you're retaining stock that you're developing, lenders are looking for a minimum of 10%, albeit that's low, but if you're retaining stock, they'll fund at that. And the minimum we work to on a daily basis is 15% if you're selling. However, when it comes down to it, we're often stressing the importance of that profit margin as a buffer for our clients. So anyway, so on to the talk. So welcome to our business. We are officially 11 years old this month. And with the greatest respect to our competitors, it goes without saying that the barriers to entry in the brokerage market are pretty low. And as a result of that, it's super important for Hallcroft to stand out from the crowd. We are a full service property finance brokerage, and we have offices in London and Edinburgh. Our experienced management team has sat in real estate transactions from the lender side, from the legal side as lawyers, and also at borrowers at one stage or another throughout our career. This vital experience is Hallcroft's unique selling point as a brokerage, as we truly understand our clients' needs and requirements and have a full and detailed knowledge of the market around us. Our success has led us to be involved in both large and small transactions, and we've grown into a lender in our own right. As a result of our success, we are now able to offer our own mezzanine funding line to property developers, and this part of our business will be covering in depth in a future webinar. So if you'd like to know more about it in the short term, please reach out. Otherwise, we'll be covering it in due course. On to our team. So I'm not sure how much you know about all of us, but look at those youthful smiles. So we have Ian Stockdale and Adrian Cormican, both ex-Clydesdale Bank. In fact, they met at Clydesdale Bank. How romantic. They're both experienced investors in their own right and experienced brokers. We have Douglas Noble as well, who's ex-Barclays and Weatherby's Private Bank. Douglas has been vital in opening up our Edinburgh office, which we opened in August 2020. And as a result of his involvement, we're already in discussions with a number of Scotland's leading development businesses. And finally, myself, I'm a former city lawyer, and I've sat as a borrower and as a lender. We are also missing off of our team page Raymond Sykes, who acts as a non-exec stroke chairman to the business. And we have our marketing capacity, Huda, who I'll touch on later. Moving on to our products. As discussed, we are a full service market provider. And so on a day-to-day basis, we deal with development finance. We are often involved in arranging bridging finance. Often that bridging finance is in relation to the development finance and plays a part in that facility. We are often arranging investment or commercial terms for larger commercial assets. And on a day-to-day basis, we can be structuring both mezzanine second charge facilities or negotiating equity investment raises. So that gives you an idea of the full package of services we offer. And there's a number of other facilities you'll see on that slide. Apologies in advance. As you can see, we're really modest. This slide gives you an idea of the track record of our business. And so this is actually a snapshot from early 2020. Mr. Cormican needs to get his finger out and start updating this. So we are over the 600 million mark in terms of finance to date, over 1,100 homes financed or delivered, and 245 retirement homes that have been delivered. On to our next slide, a little bit of latest news from our business. It's been a huge 12 months for us, to be honest with you. But as many of you have experienced, the last 12 months have been extremely tough. It was around about a year ago that effectively the world appeared to stop for us, and coronavirus effectively decimated our pipeline. We had numerous transactions and legals going through professionals, and we had many new mandates and instructions. However, they all fell away around about March 2020. And as a result, we had to kind of take a step back and evaluate where we were as a business. So we decided to take our time, reevaluate, and we divided the business into its separate component parts. And when analysing the business, we broke it into sales, operations, and marketing and PR. Once we spent time improving each facet of the business, we pulled the whole organisation back together, and we're now starting to see really positive results. As discussed, in August, we opened our Edinburgh office. Just now in February, we welcomed super talented Huda Ahmed as as our marketing executive. And Huda's super intelligent. She has a marketing degree and even a master's in digital marketing. She is very much our secret, or not so secret weapon. I was also honoured and humbled to be nominated in the 2021 Bridging Commercial Power List, which highlighted or recognised the top 40 professionals in the structured finance market. And finally, and most importantly for our business, we have just enjoyed our biggest Q1 performance on record in terms of new business inquiries received. Leading on to another question to make sure you're all still listening. What is the minimum level of equity investment expected by a senior lender? Adrian, do your stuff.
Time is running, Martyn. Give people a chance to let the answers roll in. Oh, we got a bit of controversy straight away again. Still listening? You're okay, Martyn?
I'm guessing you've got 2% of the viewers have answered.
I've already had a bit of stick in the private messaging. How many on this? 3, including himself. How cheeky, how rude.
Yeah, well, expected.
Right,
the answer. We expect to see a senior lender expects to see 10% of equity investment from the borrower. So moving on to market update and what can be relevant to our viewers and not so much about our business. Well, look, what a 12 months it's been. I am constantly asked about lenders' ability to lend, liquidity of lenders, liquidity in the market, and whether investment funds have an appetite to invest. The long and short of it is that they both are. And if we take a step back and we have a point of reflection, if you take yourself back to March and April last year, challenger banks completely dropped the ball. They moved their loan to values down from sort of 5 to 10%. Some of them even stopped funding certain deals. Regulated investment funds stopped lending. Some of them reduced their gearing, and that has led to a move from some borrowers and clients to move to alternative funding providers such as peer-to-peer platforms. Now, these P2P funds are viewed positively. We view them positively, and it's a great addition to the market. However, they have to be handled with great care and attention, as in a lot of cases when it comes to development funding, they don't raise the funds until they're through the borrowers into their development phase. and they then raise the money piecemeal, and that leads to concerns over stability of the lender, stability of the scheme being delivered, and the ability for ultimately the funder to fund the scheme from start to finish. However, once we got over the corona shock, round about June, July time, things started to improve. We could get contractors back on site, we could get materials to site, things started moving very fast. Lenders, I'm happy to say now, lenders are very much back at the coalface. They're very much back lending, and there's a huge pent-up demand in equity deals due to the lack of completed transactions in 2020. Investors are looking to get those IRR returns boosted back up and are looking to get their money moving. We've also got a number of investment funds who have got equity sitting in their bank accounts from investors where they're committed to making a return, and these funders are hungry to do deals. Furthermore, this summer, we've actually seen an unprecedented and enormous investment from government into the structured finance market. And that's through the coronavirus business intervention loan scheme facilities, or I'm sure you've heard of them, CBILS facilities. These CBILS facilities offered 12 months of interest-free debt and paid professional fees to arrange the facility. However, the scheme has now come to an end today, in fact. However, we have good news. There's a follow-up scheme. And the follow-up scheme, namely the Business Recovery Scheme, or RLS, if you'll probably see it referred to that as in the press, business press anyway, which gives lenders an 80% guarantee on loans and should see lenders reducing rates and accepting additional risk on development schemes. So super exciting to see what happens there. This is a brand new scheme, and Adrian and I are on a call with the British Business Bank and the NACFB next week to help learn further details about it and how it will be relevant for our clients. And certainly, if you'd like to know more information about the RLS scheme, reach out to Adrian or myself and we'll give you a full update on what it can do for your business. We've also had further good news in the sector. Again, government is assisting challenger banks and giving them the ability to offer 70% loan to GDV via the Housing Accelerator Fund, and aiding a limited number of investment funds to lend in areas of the UK previously thought as high risk, tertiary, or completely undesirable for those funders. And so, where is the market then? We've compiled a very simple table, which appears very small on my screen. I hope you can see it. Along the top of the screen there, we've got loan to GDV ranging from 60% up to 75% of gearing. And then down the right-hand side column, a small note on track record required to qualify for, qualify for these facilities. Down the left-hand side, you'll see a list of lenders. And so with reference to this table, you'll see that the retail banks and clearing banks are simply not in the races. They're not lending at this level, and quite frankly, they're not really lending at a lower level either. Previously, you'd see retail banks at 55% loan to GDV. They're not there. If they're lending, they're even lower than that, and so it's just not desirable, and it's not an effective facility for our clients. So challenger banks, they've come back strongly. They're up now at lending at 60%. We have some even at 70% through the government-backed funds. And so that's a really exciting development. And we've never seen 70% loan to GDV at such a low rate. So that's a very interesting development of late. Regulated investment funds, just sitting in behind the challenger banks, slightly more expensive, but will accept more risk. And your private equity funds are even stretching up to 75% of GDV. But effectively, they're coming on board in some sense as your lender and your equity partner, and as such are charging a coupon on their debts, a coupon on their equity investment, and will probably want a share of your profits as well. Just a quick note, and I want to draw your attention to the mezzanine blended rate. This is something that Adrian and I will cover in a lot of depth in future webinars, and it's something we highlight to our clients on almost a daily basis. If you're confident in using mezzanine debt and you sit a senior lender with a strong mezzanine provider, when you blend the rate together, the effective rate can be a lot lower than you think. So it's 70% loan to GDV. With a strong offering, you can be getting rates at between 9 and 10%. And if you step up to a higher risk position of 75%, you can still achieve a rate of 11, 12%, which is really attractive when you consider the capital stack. And we've got another question for you, I think. Yes. Question number 3. Which peer-to-peer lender went out of business in the last 2 years? Lendy, Oblix, Funding Secure, or all of the above? Adrian, over to you.
This will be the acid test. Let's see. This is an interesting one. I didn't get this right, if I'm honest, everyone, when we were putting this together. So a variety of options coming in. The poll's over. Well done, everyone. Martyn, back to you.
Perfect. Okay, and the answer is D, all of the above. Again, highlights the risks in these unregulated markets, these untried, untested lenders who have not shown through the course, they've not been through a number of cycles, and it's really important that you back into a strong senior lender, and you know you can have surety of funding. And so, on to the next one. The Deal Clinic. This is effectively the substance of our talk today, and I hope you find it interesting. It's certainly an interesting deal in terms of perspective. If you look at that picture there, it was, as Adrian referred to at the start of the talk, it's a vacant chicken shed, long and short of it. Not a very attractive building, a couple of vacant commercial farm buildings. So our client purchased the land and buildings for 1.1 million with the benefit of planning permission. Build costs to deliver the 5 beautiful houses at 1.6 million, and associated finance costs aggregated at around 135,000. The GDV on stage 1, or the initial proposal, was 3.7 million, and there was a forecasted profit of around about 700,000. Leading on to the next slide, the really interesting part of this deal wasn't the chicken sheds, is really the fact that they made an enormous planning gain. And within this planning gain, the drawings that were attached to the planning consent were not detailed at all. And as a result of the lack of detail in the planning consent, they were able to add significant square footage, which effectively meant that they were able to dig down by 50 centimetres, and the previous mezzanine levels within 4 of the units, those became a first floor, and that extra square footage has really upped the GDV substantially. GDV went from 3.7 up to 5.2, a gain of 1.5 million, and the extra cost on that, 700,000, a large amount of extra investment required, but clearly delivering value on GDV. So if we move on to the next slide, you'll see the beautiful end result of these 5 houses. Now, it's really interesting to note that of these 5 houses, the most expensive unit number 5 was completed on today. And these 5 houses in a almost rural setting, you could argue, they're hitting the market on the 10th of April. So the most expensive unit sold at 1.475 million today, which really shows the buoyancy in the market. And also contrary to what the valuer thought that unit number 5 would be worth, and I think the valuer might even be listening to this webinar, he had it priced at, I think, 1.25 million. And so there's been a real gain from the borrower, and they've really come through on that. So it's really exciting to see them deliver that unit and get it sold so early. Moving on to the next slide, just to start talking about the challenges that we faced as a brokerage, and also the expectation of our clients. So we face this on a regular basis where our clients will come to us, they'll have a beautiful, a great opportunity to deliver a beautiful asset, but they want to minimize their day one equity investment, and therefore they're looking for the highest loan to value on day one. Also, our client was looking for the highest loan, but the lowest rate, and we were looking for the best quality of senior lender, because we always look for a supportive senior lender for our clients, because we know that a cost overrun can come along or the market may change on them, and we want to have that support built in. In addition, we wanted, obviously, it was important for us to have that supportive lender so they could cover that extra 100% of that extra cost without further equity investment, because quite clearly in a facility agreement for each and every development, within that facility agreement, it will state that the borrower is liable for any cost overruns or any extra money required to get to PC. And so what were our solutions? The solutions we found were, so we went to a senior lender who would offer 65% loan to GDV, which is a higher, it's higher up the gearing curve. But importantly on this one, we were looking for a senior lender who could go all the way to 70% loan to value day one. Now, by going to 70% loan to value day one, or 70% towards the purchase of the land, we were actually topping out at 63% loan to GDV. Now that extra 2% of GDV from 63 to 65%, we were able to draw down after legal completion of the loan and during the build, and we drew that down by way of a development management fee. Now that takes a very flexible lender to be able to understand that the residual value of the land is potentially increasing, so they're then not so concerned about that day one loan to value. And again, supportive lender who will go over and above and assist the borrower to get out of the development what they want. Further to this, it's really important and really impressive to state that the senior lender is also backing the sale of this first unit by agreeing a partial repayment. So in relation to this unit number 5 that's been sold at 1.475 million, the senior lender has agreed that they will take 1.2 million out of that sale, and the net amount, the residual amount, will go to the borrower, effectively his equity back. He can then put it into another scheme, which helps our client grow. The next slide gives us again, just hammering down on the capital stack. So on the right hand side of the page, this is a very typical capital stack for our clients. Equity at 15% of cost, senior debt making up the remaining 85% loan to cost, and that senior debt being divided into those 3 portions of tranche A being the land loan, tranche B 100% of construction, and tranche C should be the retained interest account. And just refresher on the funding package agreed. Day one, the funding package was agreed at 63% loan to GDV. 70% loan to value was released on day one. 770k was released to the developer. 100% of build costs was funded, and that extra 2% of GDV was allowed to come out, extra encumbrance to come out by way of development management fees, so that could aid our clients' cash flow. And the cost of this facility, well, if you take a look back at that table we looked at, it was 7% per annum, so very competitive within the Challenger Bank arena. 2% arrangement fee and a 1.5% exit fee. I'll finish off with just a quick testimonial. This is from Andy, one of our long-serving clients. I've been a client of Hallcroft Finance for over 8 years, and it would be hard to overemphasize the importance they play in my business. They handle both senior and mezz funding for the development of 9 apartments plus underground parking with effortless ease. The team benefit from outstanding relationships with the strongest commercial lenders. And with that, I'll hand you across to Adrian for questions and answers.
Thank you, Martyn. Well done. Well done. While you've been talking away there, Martyn, I've been fielding the questions, and it was great to see. Thanks for all the wind-ups. Appreciate it. Trying to throw us off track. But amongst there were some lovely comments. So Gemma Squirrel, well done on all your deals today. She's celebrating with a glass of bubbles right now, completing 2 deals today. I also note that Raymond, you might want to say hello to Gemma. I understand you worked together many years ago, so I'll leave you two to get in touch with each other. Frankie, this is almost good enough for CPD. Yeah, okay, I hope so. That's the aim.
That's a compliment right there, that's for sure.
Backhanded. Right, I've got a few questions. So there's been some questions in both the private chat and the group chat. But one of the questions, Martyn, was around partial repayments. Great news that the client today has sold that for a new family moving into that site. That'd be great for them. What a lovely home. Maybe just expand a little bit more on the partial repayments and what that means, because that's something that happens at the end, which is quite hard to sell at the start of a deal, but is really important nonetheless.
Yeah, absolutely. Look, good question. It's good to touch on this again. So within the structure of any development facility, 100% of the sales from the first units will go to the senior debt provider. In a partial repayment structure, under normal circumstances, a senior lender would not consider a partial repayment to their client on the first deal that they're doing with them, or even the sale of the first unit. So actually it's unusual for us to see this, and actually it just shows that the senior lender has confidence in not only the borrower to deliver and sell, but also confidence in the market and confidence in those assets. But it's not particularly complicated in terms of how it works. We've got effectively 1.5 million of sales coming in off that first unit. 1.2 million will be retained by the senior debt provider, thereby bringing their debt down and reducing reducing their loan to value. And then the residual amount, 300k in this case, goes to the developer, and he can then use that as cash flow to go into his next development, and that's effectively his equity coming back to him.
Brilliant. Thanks very much. This is a bit of a leading question, I think, from someone in private chat again, but he says, what other professionals are involved? I think someone's looking for a job, which we're quite happy to entertain, but just maybe at the start of the process, real brief on who's involved in pulling deals together.
Sure. Again, good question. An easy one for us to answer in that regard. We deal with them every day. So in any development finance application, there will be 3 sets of professionals in the first instance in arranging the facility. That is, you'll have the valuer who will be brought in to justify and back up the GDV and the residual land calculation. You'll have the project monitoring surveyor who will justify the build costs for the lender. And then you've got 2 sets of lawyers. You have one set of lawyers who will represent the lender, and then a second set that will represent the borrower. And all of those lawyers are working in tandem to take you through the legal due diligence process. What I would say and sort of stress at this point in time is, how long does that process take? And ordinarily, if you look back at some of those retail banks, I mean, they could take up to 6 to 8, even 9 months to arrange a facility. Now we're getting pressurised by our clients because they want to get closed out on deals within maybe 8 weeks. Now, I would suggest that 8 weeks is that's the shortest amount of period you should put to this. A legal due diligence period, it takes at least 4 weeks, possibly 6. To get valuers on site, depending on how busy they are, and at the moment they're very busy, can take up to 2 weeks, and their reporting can take 2 weeks. And all the while you want to be getting the project monitoring surveyor back to work as well, so he can justify the build costs. So if you want to link that all up, you're looking at an 8 to 10 week period.
Right. I'm going to take one from the public chat. Evening, Julian. Thanks for coming along this evening. Julian asks, does the track record need to be within the same entity / company, or are you finding that personal experience / track record is of equal standing?
It's a very, very good question. And you know what? The track record is something that we deal with on a day-to-day basis. So to answer your question in relation to entities, when it comes to the developer, the lender will expect that you're going to have different projects and schemes in different SPVs, and they don't have to be connected. They can be connected, and you can have it under one group structure if you want. It might aid your tax or whatever structure you're looking for. It's fine to have it under one group. You can have it unrelated. What's really important though is we're constantly trying to get lenders to understand where maybe a more inexperienced borrower who's got huge amount of experience working for industry or larger corporations or larger development businesses have been really high up and experienced in that business, and then they go out on their own. It's their first sort of they're the principal for the first time. That experience they've had in the past is very, very relevant. So we're constantly trying to get lenders to understand that and build that into the track record. But the long and short of it is, your track record is very important for securing the best quality of lender at the not cheapest, but the best cost, and getting the highest loan to value, hence minimizing your equity investment.
Hope that answers your question there, Julian. Here's one that probably doesn't have enough meat on the bones, but I'm going to just ask you to elaborate on it. Referring to the table, and by the way, all the slides will be shared with everyone following this event anyway, but on the table that you scheduled there, Martyn, loan to value looks really good. How do I go about achieving this? Difficult one to answer, but maybe try and put some meat on the bones on that one.
Yeah, it's an interesting one there. So in many respects, the track record plays a big part in this. The more experienced you are, it's easier to get a higher loan to value and a lower rate. Challenger banks typically look for you to have completed at least 2 or 3 similar style development projects before they'll fund you. They don't really look at maybe less experienced developers. Unregulated funders and private equity funds and sometimes P2P platforms will accept less experience. So very much if you can capitalize on your experience, or alternatively you can bring a larger equity slice to the table, then you can get higher loan to values. But it's very much, we've got a shoe that will fit anyone's foot, to be honest with you, because we've got a lender that will be perfect in any scenario.
Great. I'm going to finish with one more. I'm going to leave it at this. Thank you, Frankie, for your sensible question. Do you still see costs artificially inflated to increase lending, or is this something of a bygone era? That's a good question.
Do you know what? That's a really hard one to answer. It's a good question from Frankie, but do you know what? Right now, I think we can see that certain parts of the market, you could say, are overinflated. And that's not to get deals done, but it's just the state of play in the market, given the government backing we have. I mean, never before have we seen a situation where the government is giving 95% mortgages for first-time buyers, and all the while they're backing developers and giving an 80% guarantee to lenders when they're lending money to developers to push the envelope to get houses built and deliver them to market. And so at the moment, potentially as a pent-up demand under that 600,000 average sale price, where you're helped to buy and this government-backed mortgage is going to exist, you're seeing an inflation of prices there. But certainly when it comes to house prices and the market more generally, I would have to bow to Frankie's superior knowledge. However, I would add that he did get Dunsfold wrong when it comes to that unit selling at 1.2 million, 1.475 million, and he expected 1.2 million.
Now, that's part of our job, to give the professionals a hard time. Thank you, everyone, for all your questions. Really appreciate it. I see more and more coming in as we're speaking here. Now, we'll come back to all of them. I'm going to pick one here really quickly. Anita, are the same lawyers representing the senior lender and the mezz lender? Really simple answer to that, no. For each party that's involved, there's different legal teams for each party. Andrea, I'll come back to you directly on some of your questions. Hugh, I'll come back to you on some of your questions. Thank you, everyone, for all your quite kind comments. 1 minute to 5, my 7-year-old ran in here. He hasn't been in here all day, and he decides to make an appearance just as we were about to kick off. He's been good as gold. I'll get him a few bags of Haribo now to keep him happy. There's a survey now that, as we end the webinar, there's a survey. We want to obviously make these events as good as possible for yourselves. and give value to yourselves. So if you could help us with 1 more minute of your time, answer that survey, it'd be really appreciated. Good night all. Thanks very much for coming.
Thanks, guys.